If you are retired, or if you are anywhere near sitting down at that retirement desk and signing those final papers, you need to freeze right now and pay attention to every single word coming out of my mouth. Because there is a massive, dangerous life floating around out there. People think that once you stop working, Uncle Sam stops knocking. They think, Susie, I don't have a paycheck anymore, so I don't have to worry about taxes. Wrong. You are dead wrong, and that mistake is going to drain your nest egg faster than a leak in a paper cup. The tax rules do not disappear when you retire. In fact, they get more complicated, more predatory, and if you do not understand how they work, you are going to bleed money every single year to the Internal Revenue Service, money that should be going to your security, your healthcare, your home, and your peace of mind. Let's talk about the big fear first, because I know what keeps you up at 3 a.m. You are terrified of running out of money. You spent 30, 40, maybe 50 years busting your rear end, saving every penny, sacrificing vacations, putting money into your 401k or your IRA. And now you look at that total balance and you think, that's my money. No, it is not all your money. A huge chunk of that account belongs to the government, and the second you start taking it out, they are standing there with their hands wide open. When you withdraw money from a traditional 401k or a traditional IRA, every single dollar is taxed as ordinary income. You hear me? Ordinary income. Just like when you were working 60 hours a week. If you pull out $50,000 to live on, the IRS doesn't care that you're retired. They look at that $50,000 as if you just walked into an office and earned a salary, and here is the trap that catches almost everyone: required minimum distributions, or RMDs. Once you hit that magic age, 73 or 75 depending on when you were born, the government force-feeds you your own money whether you need it or not. They tell you, you must take out this exact amount this year. The IRS takes your adjusted gross income, adds any non-taxable interest, and then adds 50% of your Social Security benefit. If that combined number goes over just $25,000 for a single person, or $32,000 for a married couple filing jointly, bang! You are paying taxes on your Social Security. Think about how low those thresholds are. They haven't been adjusted for inflation in decades. So if you pull a little extra out of your traditional IRA to buy a new car, or fix the roof, you just pushed your combined income over the limit. Suddenly, you owe tax on your IRA withdrawal and you just made your Social Security taxable. You got hit twice. That is a tax disaster. And it doesn't stop there. Do you like Medicare? Of course you do, you need it. But if your income goes up because of poor tax planning or forced RMDs, your Medicare Part B and Part D premiums will skyrocket through what's called IRMAA, Income-Related Monthly Adjustment Amount. You end up paying hundreds of dollars more every single month for the exact same healthcare coverage, just because you didn't manage your taxable income properly. Does this make you mad? It should make you mad. But more importantly, it should make you smart. Because you are not helpless. You do not have to sit there like a sitting duck and let the tax code butcher your retirement savings. So what are the actionable steps you need to take right now to stand in your truth and protect your money? Number 1, look at your account mix today. Where is your money sitting? If every single dime you have is in a traditional 401k or traditional IRA, you are in the danger zone. You need tax diversity. You need money in 3 buckets: taxable, like a standard brokerage or savings account; tax-deferred, your traditional IRA or 401k; and tax-free, a Roth IRA or Roth 401k. Number 2, consider Roth conversions before you hit RMD age. If you are retired or about to retire, and you are in those lower income years between the day you stop working and the day you take Social Security or RMDs, that is your golden window. You convert chunks of your traditional IRA into a Roth IRA. Yes, you pay the tax on the conversion today, but you pay it at today's tax bracket, which might be the lowest bracket you'll ever see. Once that money is inside the Roth IRA, it grows tax-free, it comes out tax-free, and under current law, Roth IRAs have no required minimum distributions for you during your lifetime. That means you control your income, not the IRS. Number 3, understand the standard deduction rules for seniors. The IRS does give older Americans extra help. When you turn 65, you get an additional standard deduction on top of the regular standard deduction. Plus, with temporary senior tax breaks like the enhanced senior deduction created under recent legislation, single filers age 65 and older can shield significantly more income from taxation, provided their modified adjusted gross income stays under certain phase-out limits. Married couples filing jointly where both spouses are 65 plus can stack these deductions to keep tens of thousands of dollars completely tax-sheltered. Know your numbers so you never pull out $1 more than what your deductions can wipe out tax-free. Number 4, use Qualified Charitable Distributions, or QCDs, if you are 70 and a half or older. If you give money to charity, do not write a check from your personal checking account. Send that money directly from your traditional IRA to the charity. It satisfies your required minimum distribution, it never touches your taxable income, it lowers your AGI, and it keeps your Social Security and Medicare premiums safe from tax hikes. That is how you play the game intelligently. People, retirement is supposed to be the time where you enjoy the fruits of your labor, not a time where you live in fear of the IRS. You work too hard for this money to give it away because you are too lazy or too scared to learn the tax rules. Take control of your finances today. Know where your money is, plan your withdrawals strategically, keep your income under those dangerous thresholds, and stand powerful in your money. Because when you are securing your financial life, you are powerful in every area of your life.